talk about in this lecture is the way in which economists and historians, and I should tell you I'm a historian, not an economist, understand the both current history, the world of in the aftermath of the financial crisis of 2007 and 8, but also the past. And the key thing, first of all, my key starting point, is what it says at the start here. I suppose you could say, summarise this as history matters. The way we understand the present, the past, shapes the way we see the present. That's why in 1984, you may remember one of the slogans of the party was, "Who controls the present controls the past, who controls the past controls the future." Because it's the way we understand history that determines our understanding of why we are where we are, but also how to make sense of things that happen now. So what that means in concrete terms is that in many ways, the way we understand what happened in previous economic crises, and particularly the understanding that people have of what happened in the 1930s, tends to influence the way we understand what is going on right now and what happened in 2007, 2008. One of the things I'm going to argue is that perhaps we need to pay more attention to an earlier episode in economic history, the so-called long recession of the 1870s to 1890s. The 1930s is perhaps not as good a guide as you might imagine, but generally speaking, that is that's kind of basic background for what I'm going to say. Now, the other thing I want to say is that the common way of thinking about this is to think that both in terms of the history and the present, there's a division between pro and anti-market people. On the one side, you have people who broadly favour free market policies, a free market approach. On the other side, you have people who broadly think that government should be doing more. Actually, that's not right. The real division is between people who think that the problems of, say, the Great Depression in the 1930s and what we have now are caused by mistakes in government policy. Somebody boobed, somebody screwed up, and those who think that while there were policy errors, it was more due to some kind of structural fault in the way the economic system was set up. So think of it by analogy. You have a car which is being driven along the road, and the car has gone into the ditch, and everyone is sat there very shaken, maybe cut and bruised, and wondering what the hell has happened. One kind of explanation would be that the car went off the road because someone was driving too fast. The driver braked too hard. The driver steered the car the wrong way. In other words, somebody in control of the car made a mistake. On the other hand, other people might say, well, yes, indeed, the driver was going too fast. But, wait a moment, this is the 20th time that the car has gone off the road into the ditch at this point. A car of this kind has gone off the road. Maybe there's something wrong with the design of the car, or maybe there's something about the way the road is built, which means that that particular place is unsafe. So you see there are two kinds of different explanations there. One emphasises human error, the other says there is a part for human error, but the real factor is something systemic. So there are some economists who think that the reason why we had the Great Depression in the 1930s and the reason why we had the current financial crisis is because of mistakes made by policymakers. The other view is that there's something structurally awry with the economy, and that this is sooner or later going to cause something of this kind to happen. And that would be, and the thing is, you find pro and anti-market people on both sides of that divide. There are pro and anti-market people who think it's policy errors. There are pro and anti-market people who think that there's something structurally flawed about the way we're doing things at the moment. So, first of all, what about the influence of the 1930s and our understanding of that on what we think is going on now? And the answer is it's considerable. there are all kinds of people, notably Paul Krugman, but others as well, who are saying, well, look, really, where we are is exactly where we were in the early part of the 1930s, and we're making exactly the same mistakes that we did then. That's the thing which he says in his column every week, basically. Along with what a wonderful chap he is and how he's right and everyone else is wrong. That's his other constant theme. So, what about the history? Well, there's a kind of standard, couple of standard narratives about the history of the 1930s. The first is that in the 1920s, you had a big boom in the United States. The American economy grew very, very rapidly in the 1920s. So at this point, however, what happened was that the system went off the rails. There was the crash in the stock market in 1929. Subsequent to this, there was a wave of bank failures in the United States. The American economy contracted dramatically. Now, the standard narrative for this is that the problem was that the president who was elected in 1928, Herbert Hoover, was a do-nothing president. And he just wasn't prepared to respond to the crisis which had come out of unregulated capitalism at the end of the 1920s. And that eventually things were only saved when Franklin Roosevelt, well, I was about to say rode into town on a white horse, but of course that wouldn't be appropriate in his case. When Franklin Roosevelt became president, and he made the government start actually doing things, and the economy then recovered. A couple of things wrong with that, by the way, which all historians think are wrong. This is not something I think. The first is, Herbert Hoover was not a do-nothing president. Actually, during his term of office, federal spending doubled as a share of GDP. In nominal terms, it went up by 12%, but because the American economy shrank so much at that time, and the share of GDP taken by government spending went up by 100%, so it doubled. So, in fact, Herbert Hoover was not a do-nothing president, quite the contrary. Moreover, not only did he increase government spending quite dramatically, he also engaged in all kinds of other activities and interventions which were designed to do various things. What he did, more about that in a moment. Secondly, it's not the case that the New Deal, the policies of Franklin Roosevelt, ended the Great Depression in the United States. Nobody who knows anything about the history thinks this. Because if you actually look at the American economy, by 1937, it's in just as bad shape as it was in 1932. It recovers quite well between 1932 and 1935, 36, but then it has another massive crisis in 36, 37. And a lot of historians think that, in fact, the only thing that Roosevelt did that did any good was going off the gold standard, and that the rest of the policies of the New Deal, if anything, actually made anything worse. And in fact, the American economy remains in recession until 1948. Now, you may think, hold on, what about, didn't the war bring the Great Depression to an end? Well, the answer is no, it didn't. It got people back into jobs, but what were those jobs? Those jobs were building weapons of destruction, basically, which is not actually productive activity. If you strip out war effects, then in terms of actual wealth creation, the American economy does not really recover until 1948. So the effect of the New Deal is actually to prolong the slump compared to other countries like, say, Britain or Germany or even France, which is the other country which, besides the US, has a really bad time during the Great Depression. So how is the 1930s understood? Well, there are broadly three sort of accounts, or classes of accounts, that you can give. The first is associated with Milton Friedman, and in particular with the book he wrote with Anna Schwartz, Monetary History of the United States. Friedman says that what you had was a major policy error by the Federal Reserve. He said what had happened was that the Federal Reserve had, first mistake, expanded the money supply a bit too rapidly in 1926, 1927. What they then did, second mistake, was to suddenly put their foot on the brake and start to raise interest rates and tighten the money supply in the spring of 1929. And this provoked a crisis and a recession. But the big mistake, the third mistake, according to Friedman and Schwartz, was that following on from that, what they should have done was relaxed monetary policy in the short term. They should have cut interest rates, they should have expanded the supply of money to make sure that the recession that took place in 1929-30 was relatively short-lived. Instead, what they did was to raise interest rates even more, and they actually contracted the money supply by 25% between 1929 and the end of 1930, start of 1931. Not surprisingly, the result of this was disastrous. You can't shrink the supply of money in the economy by 25% and not expect some pretty big consequences. And the major consequence was an enormous crisis of liquidity in the US economy, says Friedman, plus a wave of bank failures. And the result was a crash in economic activity, huge numbers of firms that were actually solvent going out of business because they couldn't get the liquidity they needed, major crises in the banking system, and a collapse in employment. Until by 1932, 1 American of working age in 4 is unemployed and drawing relief, which is a truly disastrous situation, the kind of situation we currently have in Greece, for example. So that's Friedman's account. Friedman's account of the Great Depression is basically that it was brought about by a policy error by the Federal Reserve. They expanded credit too easily in the 20s, they then stamped on the gas too hard, the brake too hard, I should say. They brake the car too sharply as they came into the corner, and then they compounded that error by shrinking the money supply dramatically in the early part of the 1930s. So that's Friedman's explanation. And his explanation for the partial recovery after 1932, which is also the argument put by a number of other economists, notably Barry Icke and Green, is that the US went off the gold standard, which had the effect of loosening monetary policy and sort of counteracting the previous contraction. Plus the Fed started to relax the money taps a bit more after 1932, so the economy recovered. But all the things that Franklin Roosevelt did actually hampered the recovery because they raised the cost of business, they made the business climate more uncertain, and they basically just screwed up the recovery until the war came along. So that's Friedman's explanation. The Keynesian explanation is that there was a massive collapse in demand, aggregate demand, between 1929 and 1932. Now, what the federal government then did in 1932 in the United States was to boost and revive demand, and to do this by public spending. The problem is they didn't do enough of it, and they stopped too soon in 1936. They should have kept going longer. Paul Krugman is constantly saying this. And so the idea is that basically they had the right idea, but they just didn't do it enough. What they should have done was run even bigger deficits, spent even more money, and kept going. It's worth saying, I'll return to this in a moment, there is a problem with this whole model. You may notice there's a slight circularity to the argument, but I'll come back to that later on. The third argument belongs to the second category, and this is the argument put forward by Friedrich Hayek, but also in a slightly different form by other people, including the fellow I mentioned in my first lecture, Irving Fisher, the man who'd quite literally bet his mortgage that the stock market would keep on going up in 1929. In the aftermath of 1929, Irving Fisher came up with a different model of what was going on. He sort of thought about this before, but he elaborated it after that. These people say that the problem was there was a structural fault with the way the money system worked, although they disagreed about what that fault was. But what they agree is that what was going on in the 1920s was an unsustainable boom, and that there was a huge amount of malinvestment. Malinvestment in particularly assets which yielded an income, such as equities, but also in other things such as land in Florida, real estate generally, and a whole lot of productive assets like much too much productive machinery, actual capital goods in place by the end of the 1920s. Too many factories in Detroit, that kind of thing. And the argument is that what should have been done under Herbert Hoover is what his Treasury Secretary, Andrew Mellon, wanted to do, which was to, as he was put it, liquidate everything. Liquidate farms, liquidate business, liquidate stocks. In other words, you had to basically write off the bad debt. Herbert Hoover very vigorously said, the liquidationists, as he called it, I just wasn't going to listen to them, and he definitely didn't. So the argument is that Mellon was right, and what should have been done was to liquidate all the bad investments. The argument is that this is what had been done in 1920. During World War I, the price level in the United States almost doubled, and there was an enormous inflationary boom. In 1920, what Mellon, as Warren Harding's Treasury Secretary, did was to stop all that and to liquidate all the malinvestment. You had an intense recession in which US GDP dropped very sharply, but it only lasted for 9 months in 1920. After that, the US economy began to grow very, very rapidly, partly due to the fact that what Mellon also did was to bring through a whole program of dramatic cuts in taxation on both income and on business, more generally on profits. And the result was the large technology-fueled boom of the 1920s. So, according to that third theory, what should have happened is that the malinvestment of the 1920s should have been written off. They should have done what they'd done in 1920, but they didn't. And the result was that you had a depression that went on and on and on and got worse. So that's the kind of broad theory. Now you'll notice that, as I say, there are pro and anti-market people on both sides, but I'll expand that more when I talk about the sort of way to understand the present crisis. So what have we got here? Well, we have almost exactly the same division. Basically, the first big question is, okay, what do we make of the world economy, the European economy, in the 10 years between roughly 1997 and 2007, 2008? One view is that things were going pretty good. The world economy was growing at roughly 5% per annum. Obviously, different rates in different parts of the world. But it was growing pretty steadily. We had the great moderation. We seem to have cracked the trick of having rapid growth but stable prices, or stable rates of inflation, I should say. Low inflation. The prices are still going up, but the rate of inflation is low and it doesn't seem to accelerate. We have pretty, good levels of employment in most countries. The world, things look pretty fair. So the idea is, according to all these economists, that things were going on, pretty smoothly in 2000 and those 10 years. You had a few problems. You had a real estate bubble here. You had an overheating of another economy there. But generally speaking, there wasn't any kind of fundamental basic problem with the way the world was in 1997 to 2007. Then, according to these guys, somebody screwed up. Somebody made a major error. And what the economists then disagree about is what that error was and what we should have done. So there's two groups of economists. They both think that the world was doing fine before 2007, but they disagree about what then went wrong and what should have been done. Okay, the third group is a much more various and heterogeneous group, and these people think there was something deeply problematic about what was going on in the world before 2007. And what they all agree is that while there was genuine growth going on, particularly growth in China, India, Brazil, other parts of the world, a lot of the growth that was recorded, and a lot of the growth that was recorded in North America and large parts of Europe was what you might call spurious growth. It wasn't a real growth in productive capacity. The production possibility frontier for economies had not actually moved out. What had happened instead was that you had artificially inflated GDP figures. How artificially inflated? Well, according to this third group, if, for example, the nominal price of a major asset, such as houses, is seriously inflated above what it realistically should be, and those houses are being bought and sold in very high volumes, and even more to the point, things associated with them, such as securities, or the products that are associated with housing, were also being bought and sold in very high volumes, that's going to show up in an inflated level of GDP. Because GDP just measures the value of all the financial transactions in the economy. So if the value of housing is inflated, then the value of all the transactions involving housing is going to be inflated, which means that the level of GDP is not as big as you really think it is. So a lot of the growth that you were having in that decade was actually fluff. It wasn't real growth. There was no real increase in wealth. What there was an increase in nominal paper wealth brought about by inflation in the value of assets of one kind or another, and artificially created income streams. And at that point, basically, the chickens came home to roost, as we say in English. Things happened really badly. So that's a different argument. Now, let's go through these in turn then. The first two groups. The first group are, I think, the majority of the economics profession. And they think, basically, it's the money, stupid. These people think that what went wrong in 2007-2008 was an error in monetary policy, which was then not sufficiently addressed after 2008. The point is that up until about 2007, the world's money supply was growing very rapidly. It was in double-digit figures. Very hard to work out exactly how much. Some people say 14%, some people say 11%, some people say just around 10% or even 9%. But whatever the argument is, the precise figure is, and we'll probably never know the exact answer because it's increasingly difficult to actually answer the question, what is money? There are so many liquid instruments out there that have a money-like function that it's actually quite difficult. But whatever it was big. And then what happened was that, according to these economists, in 2006, 2007, the world's central bankers and the Bank of International Settlements, which is a kind of international organisation for central bankers and major banks, got worried about what was going on in the banking system. They became worried by as they saw increasingly excessive indebtedness of large parts of the population of the developed world in particular. And they became alarmed by the increasingly high leverage ratios that banks had. Are you familiar with what that means? Basically, this is to do with the way fractional reserve banking works. If you go and deposit £100 or dollars or euros in a bank, I don't know if you realise this, but that is no longer your money. You don't own it anymore. You've lent it to the bank, is legally what you've done. It is a loan that you could demand repayment of in full immediately at any time, but you have no longer owned the money. What the bank then does is to create credit on the back of your deposit. But there's a leverage ratio, so if you deposit £100, the bank may then create £400 worth of loans. It may lend out your £100 4 times, effectively. That's a leverage ratio of 4 to 1. By the time you got to 2006, many banks had leverage ratios that were about 26, 27 to 1, or even higher. And the central banks and the BIS became increasingly alarmed about this. So, what happened was that the international these international organisations and the central banks suddenly contracted the supply of money effectively by insisting that banks have higher capital reserve ratios, reduce their lending ratio. And they also, at the same time, basically started to raise interest rates, slowly but surely. The result of these two things was to raise the cost of money and to suddenly dramatically stop the growth in the world money supply. And the argument is that what this then led to was a dramatic sudden decline in economic activity. Now, let me say before we get, there's one problem with this model. If you look at the actual figures, they seem to bear out the prediction quite clearly. If you look at the graph for world economic activity and world money supply, sure enough, about 18 months to a year before the financial crisis hits in the autumn of 2008, well, spring to autumn of 2008, there's a sudden sharp decline in the expansion of money supply. Think, oh, bingo. Trouble is, if you look at the last 25, 30 years, you would have predicted a recession in something like 11 of 19 years, because there have been sharp reductions in the money supply before, which didn't lead to a major recession. So, on its own terms, I think that theory has serious problems. But that's the argument they make. So the argument is that what provoked the crisis, what brought on the crisis, was suddenly, abruptly, reducing the supply of money. You'll notice this is very similar to Milton Friedman's explanation for the Great Depression. What should have been the appropriate policy response? The appropriate policy response, they say, is first of all what was done. Big cuts in interest rates, quantitative easing, printing money. But, they say, it wasn't big enough. We didn't create enough money. And also we gave it to the wrong people. Ben Bernanke has been creating, some huge amount, $85 to $90 billion a month of credit by buying up long-term debt. But most of that is money that's effectively gone to financial institutions. Similarly, the Bank of England has had quantitative easing, which has been on £285 billion sterling is the current latest estimate in total. But again, it's gone mainly to financial institutions. These economists I'm talking about think that what they should have done is, for example, the federal government in Washington should simply have mailed a cheque for $10,000, let's say, to every household in the United States, because they would have spent it. So the idea is that the monetary policy, the quantitative easing, should have been much, much more aggressive. They should have been buying unconventional assets, or literally just giving people cash. Friedman again said that this is what the Bank of Japan should have done during the 1990s. His famous line was that they should have, if necessary, they should just throw money out of helicopters. And Ben Bernanke then used this expression later on in the speech, so it's associated with him a lot these days. In other words, you should literally just drive along the street and throw money out of the window, basically. But whatever you should do, you should expand the money supply like mad. And you should do it until the economy starts to grow again. At that point, you have a problem because you now have all that money out there that you've created, and it's probably going to cause inflation. So what you do is you very hurriedly sell a whole lot of government debt to take the money out of circulation. Well, nice luck with that. But that's the kind of theory. So that's the first lot of economists, broadly pro-market, but they think that the reason why we had the crisis was because various bodies basically suddenly stopped growing the money supply the way they had been before. This caused a liquidity crisis, which led to an actual financial crisis, which then became an insolvency crisis, because the monetary response of the central banks was not aggressive enough. And what we should be doing is pumping money into the economy like there's no tomorrow. They also think, though, that we should be cutting back government spending, on the grounds that high levels of government spending will deter economic activity for various reasons. A, because of the effect it has on confidence, and B, because it will tend to crowd out private investment. It's to do with the loanable funds theory of investment. So that's the first group. The second group are the Keynesians, Paul Krugman, Brad DeLong and company. They present themselves as being the defenders of orthodoxy against heterodox idiots. Although for Krugman, anyone who doesn't agree with him is an idiot, apparently. These people, they're not, though. They're the minority. They are not the majority opinion amongst the economics profession, it has to be said. Now, what do they say happened? Well, they don't disagree entirely with the diagnosis that the first lot have. They do think there was a monetary crunch. But they think the main thing that happened was that there was a massive blow to demand, brought about by the collapse of the housing bubble in the United States and elsewhere in the world. What happened was that a lot of people, a lot of households in particular, suddenly found they weren't as rich as they thought they were. And so consequently, they say, what happened was that they just cut back massively on their spending. There was a huge collapse in demand. And their argument is that at the moment, the household sector is deleveraging like mad. They're paying off their credit cards, they're paying off their mortgages. The corporate sector is panicked because they know that the household sector is not spending, so they think no point in making things or investing, no market for our products, so they're just sitting on cash or investing it in very secure interest-bearing bonds. So according to Krugman and the others, the only party that can maintain demand and restore the demand that's been lost because of the shock of a bubble bursting is the government. So the government should be spending money like there's no tomorrow. So whereas the first group think that the solution is really aggressive monetary policy, Krugman thinks the solution is really aggressive fiscal policy, and that we should be spending money, as I say, like the government should be spending money like there's no tomorrow. Krugman argues further that monetary policy is okay, but it's not going to be effective because he thinks we're in a liquidity trap. We are in a situation where the stable equilibrium between investment markets and money markets is negative, which means that as I said in the first talk, no matter how much you pump up the supply of money, it's not going to do any good because the interest rates are at the zero lower bound. He does allow that one way out would be to credibly commit to higher future inflation. In other words, if the Federal Reserve could persuade Americans, or the ECB could persuade Europeans, that they're relaxed about inflation and they're going to let inflation rip for a bit even and not raise interest rates, then that would make monetary policy effective, because in that case you would have real negative interest rates. And also, in terms of the psychology of investors, if you're sat there with €1 million in your bank account and you think, well, the ECB is just going to let inflation rip at 6-7% and not raise interest rates, you might as well invest that money in something that's going to at least maintain its value and not let it sit in the bank. So the idea is that what Krugman does say is that if the central banks would credibly commit to not raising interest rates, even if inflation takes off, then that would also do the trick, because it would then bring the equilibrium point on the ISLM diagram above zero. People would start to invest again. He thinks, though, that the central banks have a credibility problem, that nobody believes that they won't raise interest rates. Now, I must say, that is actually quite bizarre, because one thing central banks have not been good at is controlling inflation. But the trouble is, he seems to be correct about this, because the markets do indeed clearly expect that central banks will raise interest rates sooner rather than later. And I think this reflects a perception about what the politics of central bank policy are, as much as anything else. So anyway, going back to them, what is wrong with this? What is the problem with this model and explanation? Well, first of all, it's not an adequate explanation of why there was such a huge crisis in 2007-2008. If it's just a matter of a blow to demand, why was the crisis so acute? Why is it, above all, that there's such a huge number of firms and households that are still basically, as I say, in this zombie state? They're only ticking over. If it was simply all about demand, you wouldn't have expected to see such widespread hysteresis effects in the economy, as they're called. Effects where there seems to have been a significant reduction of productive capacity for one reason or another. The other problem, and this is a problem for both of these groups, is something I alluded to earlier. At what point is Krugman going to say that we've tried his policy and it hasn't worked? Suppose I say to him, look, Paul, we have been running a huge budget deficit. The government has indeed been spending money like mad, and we still haven't seen an economic recovery. What do you think his answer would be? What would he say to me? What has he said to lots of people who've made that argument?
Spend a lot more.
Yeah, we haven't spent enough. The point is that for him, no matter how much money deficit the government runs, if it doesn't lead to an increase in economic activity, then by definition you haven't spent enough. Now, the trouble is, there's a problem, never mind the evidence, there's a problem of logic with that. That is a circular argument. Technically, that is what in logic is called a tautology. It's an argument where the conclusion you are attempting to prove is actually one of your premises. The conclusion he's attempting to prove is that we need a level of deficit spending in order to get growth going again. But his conclusion, his premises are, the problem is caused by a deficit in demand. The only way to address it is by increasing government spending. Therefore, no matter what level of government spending you have, if the economy doesn't revive, that just shows you haven't spent enough. In other words, there's no way of disproving his argument, which makes it a worthless argument. The same is true for the monetarist people, by the way, in terms of expanding the money supply. No matter how much you expand the money supply, if the economy does not recover, they just say, well, you should have done more, or you stopped too soon. That's the other alternative excuse. Plus, there's a more basic problem with Krugman's argument, and the argument of those like him, and that's this. Keynesian stimulative effects have a diminishing marginal return. No economist denies that for the government to run a budget deficit will have stimulative effects in the short term. Nobody denies that. But those effects have diminishing returns. Suppose you are running a deficit of 5% of GDP. It does not follow that a budget deficit of 10% of GDP is going to have twice the stimulative effect. It's not. It's going to have less of a stimulative effect, and it may even have a negative effect, because it starts to lead to serious misallocation of resources. So the point is this: there's a limit to the effective use of fiscal policy. But he's not prepared to admit this. His argument essentially is, well, there's no diminishing return. Now, when you think about it, that's ridiculous. If that is true, then why stop at 10%? Why not have a budget deficit of 100% of GDP? You might as well, because it's going to be 10 times bigger than a budget deficit of 10%. But the fact is, of course, nobody actually believes that. Everybody knows that if you do have really big budget deficits, there are significant negative effects. So the question, which is a much more pragmatic and empirical one, is what is the level at which the effects of government deficit spending start to become negative? And there's quite a lot of evidence that the result is actually quite low, that it's not much more than about 4 to 5% of GDP at most. So, what about the third thing? Well, for the third category, as to explain what happened, there's actually 3 people, I'll say here, that I mentioned, 3 M's. 3 schools of economists who take the view that there's some kind of structural problem that we face. And who are these 3 M's? Well, they're people who, you'll be surprised to hear this, agree almost entirely about what actually was going on during the crisis and what caused it. But they disagree very much about why that is the case and about what we should do. 3 people are these. Karl Marx, Ludwig von Mises, and Hyman Minsky. I'm sure you know who the first 2 are. How many people here know who Hyman Minsky was? He's an economist who's sort of unknown for most of his life, but making quite a comeback there. He read a book called Stabilizing an Unstable Economy, and he's responsible for what's known as the Minsky moment, which is the moment when a bubble bursts, basically a widespread term in financial economics. Very different people, very different ideas about what to do and about what the ultimate long-term cause is. And the 3 schools, obviously Marxists, Austrians, in the technical sense, and post-Keynesians. They're the people who follow Minsky. But these are the 3 groups of people who have a good strike rate in actually predicting the crisis. When the Queen, my Queen that is, Betty Windsor, when she visited the LSE soon after the crisis had broken in 2008, about a few months later, she said to the economists there what I think a lot of her subjects were thinking. So you've got all these economists here, how come none of them saw this happening? Why did nobody predict this? Or even have the slightest sign that it was coming? And let me tell you actually, one thing that is extremely entertaining but also rather depressing is to go and read old newspaper reports and articles by economists in the years before the crisis and to see the kind of predictions they made. And let me tell you, almost none of them had any idea that there was a major crisis on the way. And the ones who did think that there was a major crisis on the way tend to belong to one of those 3 schools. They're either Marxists, they're Austrians, or they're from the post-Keynesian school, people like Nouriel Roubini or Steve Keen or people like that. They all said, look, something really bad is about to happen. They paid attention to those 3 warning signs I told people earlier. I actually spoke to a group like this in 2006 and said, I think there's a big financial crisis coming. And people came up to me the following year who'd been at the lecture and said, you're a genius. How did you know it was going to happen? And I was like, I'm not a genius, I just looked at the fact that house prices in Britain have a historical long-run average of house prices to income, that is, of 3.5%, 3 to 5, 3.5. So typically the average house in Britain costs 3 times the average income. That's the long-term thing. At that point, they were about 7. The average house price was 7 times the average income. And you don't need to be a genius to know that that means you're in the middle of a completely unsustainable bubble and that it's about to burst. And the results are going to be very, very unpleasant. They were more unpleasant than I anticipated, though, I have to say. having said that, so what do these people all agree on? What is it that Marxists, Austrians and post-Keynesians all agree about? They agree that what we had leading up to 2007 was a completely unsustainable boom driven by a massive expansion of credit engineered by both the world's central banks and also, to be fair to them, the private sector as well. So what you had was 10 years of massive expansion of credit. At the same time, there was a systematic misevaluation of risk. Why does this? Well, for two reasons. The first was that people in the financial services sector believed, rightly as it turned out, that no matter what they did, the government would bail them out. Now think of it this way. Suppose you're playing poker and you believe that no matter what losses you make, somebody there with a huge sack of money is going to make good your losses. How are you going to play poker if that is the case? You're going to be utterly reckless. You will bet the house on a pair of twos, essentially. It doesn't matter what kind of hand you hold. You'll go big. The point is that the understood guarantees that the central banks were offering to the private sector financial services industry meant that the people in that industry, quite correctly as it turns out, thought that they could be as reckless as they liked because they were going to be bailed out. The result was they did not have a proper awareness of what risks they were facing. The other thing was at the same time there was a kind of intellectual illusion going on amongst the private sector, which was the belief that they had managed to get rid of uncertainty and turn it all into risk. And the idea was that because of modern financial instruments, nobody was ever any longer at any serious kind of risk, because risk by definition is an event, the chance of an event happening where you know the probability that that event will happen. And what that means, therefore, is that you can hedge against it. You can take out insurance, you can use various kinds of vehicles to hedge against the risk, make some other party bear the risk. Now, by contrast, uncertainty is an event where you have no idea of how likely it's going to be. The distinction between risk and uncertainty was made first by an American economist called Frank Knight back in the 1920s, and Knight is an economist that I think deserves to be rediscovered these days. So what all these private investors believed was that they no longer faced uncertainty. They thought that they had all their risks completely covered and hedged. In one very specific case, people who bought mortgage interest-backed securities, secured on mortgages on American real estate, thought that because of all the ways these securities were set up, there was absolutely no risk that they would lose their money. What they didn't anticipate was the chance that there would be a general decline in house values throughout the whole of the United States. And that was the one thing that they thought just couldn't happen. Now, why do I start my 10 years in 1997, by the way? Well, and that's why all three of these groups think that 97 was a key point. That's because that year saw something which I'm afraid confirmed both of those beliefs. And it was also the year which saw the start of the excessively cheap money and low interest rates that were fueling all the credit expansion. Two things happened in 1997. One was there was a major financial crisis in various parts of the world, particularly in the Far East and in Russia. The Russians did various bad things, including defaulting on their sovereign debt. And the result was that, partly in response to this, the Federal Reserve in the United States, Alan Greenspan, God bless him, decided that this was the time to turn the money taps on. But something else happened. There was a company called LTCM, Long-Term Capital Management. This was a hedge fund run by two Nobel Prize-winning economists, Scholes and Black. And it was run on the basis of the thing that they had got the Nobel Prize for. This was something called value at risk management. Now, how did that work? Well, I don't want to go into the details. I don't really understand it all myself, to be honest with you. But it was a metric which enabled you to work out what the risk of a loss on any kind of investment portfolio was, given the likelihood of certain events. Just one little itsy-bitsy, teeny-weeny problem with this model. First of all, they assumed that the risk distribution was Gaussian. They assumed that it was a curve that looked like that. pure assumption. There are lots of reasons for thinking the risk distribution is not like that. And in particular, that the chances of tail events, extreme events happening is higher than they thought it was. But then to compound that problem, they basically said, okay, in constructing this model, we will ignore here and here. We'll ignore these bits. We'll only look at the central mean average, the standard deviation gap. We'll cut off the tails. Why did they do this? Well, they actually said, well, if we put the tails of the distribution in, the model didn't work. Excuse me, this is meant to be a model which protects you against risk, but it's a model which we now realise only works when the risks are within the fairly standard normal range. For heaven's sake, the precise time when you want to be protected against risk is when you get an extreme event, which has a lot of things. Anyway, they decided that, according to their model, the chances that Russia would default on its sovereign debt were 1 in several million. Oh. So, as you may mention a moment ago, what happened was that the Russian did default on its debt. And so they went bust, and they lost an absolutely staggering amount of money. I mean, simply staggering. So what did Alan Greenspan do? He did not let Scholes and Black suffer not only humiliation but lose all their money. He organised a whip-around amongst all the big financial institutions in New York to bail them out. This became known as the Greenspan put. The assumption was gained, quite correctly after that if any financial institutions got into large trouble, they'd be bailed out. And that if ever there was any sign that the US economy was slowing down, or that the value of stocks and shares or things were slowing, Greenspan would probably turn on the money taps and everything would be going again. So, going back to the original thing, these three groups of people all say, okay, what have we got going on in the 10 years before 2007-8? We have, first of all, an unsustainable increase in the supply of credit, which, if you remember the Austrian business cycle theory, is leading to massive malinvestment. Lots and lots of investment projects are being undertaken. People are buying really expensive houses, which they can't afford, but in the expectation that there will be enough income in the future, or even more alarmingly, in the expectation that they will not even live in the house. They'll simply sell it on to somebody else for a capital gain. Lots of other malinvestments going on too. Plus, at the same time, people's behaviour is distorted by the fact that they think that risk has been conquered, and no matter what they do, they can always get bailed out. As I say, it's a fatal combination of private sector failure and hubris and government mismanagement. Now, why do I say that this is structural? Well, what all three of these people think is that there's a structural flaw in the way the economy is organised that makes this kind of crisis more likely. If you read Marxist accounts, including Marx's own accounts of financial panics in the 19th century, or Hyman Minsky's account of how financial panics work in the Minsky moment, or Ludwig von Mises' account in Theory of Money and Credit, what will strike you is how amazingly alike they are. They're all on the same page, basically. Their description of what actually goes on in a crisis is almost exactly the same. Some of them make quite entertaining reading as well. Marx's account of financial crises that you get some of his journalism is highly entertaining. He has lots of extremely funny things to say about the idiot investors who had lost all their money. But where they differ is what they think the flaw. Marx, of course, thinks that the flaw is the logic of the capitalist system. He thinks that the logic of the capitalist system is that you're constantly looking for more profit, and that after a while the interests of the capitalist class, in terms of greater profit, work against the interests of the system as a whole, and this tends to manifest itself in these booms. He thought, by the way, that the way you got out of the boom was by liquidating a lot of wealth and having a war. That was his sort of perception of what was done. Minsky thinks that the problem is the way the financial services sector works. His argument is that unless the government controls it, the financial services sector and the investment market are always going to periodically lead to irrational exuberance, to use Alan Greenspan's phrase, and you're going to get a bubble. So his solution, Marx's solution, of course, was to move to socialism. Minsky's solution is to massively expand government control of the financial services sector, basically, and for the government to take over a lot of the investment process. So it's a kind of radical social democracy. Mises' argument is that the crucial problem is government manipulation of money, and particularly the existence of central banks. The real problem is that states, from kings onwards, first of all, have a monopoly on issuing money, and secondly, that in the modern world you have the creation of institutions like central banks. And what this means is that constantly politicians are going to be subject to the temptation to keep booms going on, to start booms in the first place, and to then keep them going for as long as possible. And the result will be, what I mentioned in the first lecture, a massive build-up of malinvestment, and then ultimately an enormous hangover. And that, in fact, is the analogy that Mises and his followers use. Basically, the boom is like a party. It's a party, you're all having too much to drink, you're drinking lots of liquor, and after a while there's what you would call the pint of no return. It's that critical drink that makes you lose your capacity for judgment. When you're about to have that drink, you know, I shouldn't have this drink. If I have it, I'll feel ill tomorrow. But you have it anyway. And then at that point, you lose the ability to make judgment. You just keep on drinking. You forget that you don't feel bad. And then the next morning, you wake up and you feel as though there is a pneumatic drill going off inside your head. And you feel as though an animal has crawled into your mouth and died there. And generally, and when somebody opens the windows and light shines on your face, it causes real severe pain and this kind of thing. So the point is, though, the problem is not the hangover. The problem is that you drank too much the night before. The hangover is actually a sign that your liver is doing its job and purging your body of all the poison that you foolishly put into it the previous night. So similarly, by analogy, the problem is not the bust. The problem is the boom. Because what you get during the boom is massive misallocation of resources. The bust is the necessary, like the hangover, is the necessary corrective. It's the period when you basically get rid of the mistaken investments that you've made during the boom. Hence the kind of saying, the boom is the problem, the bust is the solution. Of course, better not to get drunk in the first place, and then you wouldn't have a hangover. Better not to have an unsustainable boom in the first place, and then you wouldn't have the need for this big recession to cure it. So these economists all think that there's some kind of structural design flaw, if you will, in our current economic arrangements. For Marx, it's capitalism itself. For Minsky, it's having a completely unregulated, as he thinks, financial system. For the Austrians, the flaw is essentially letting politicians control the supply of money and the rate of interest because of the incentives facing politicians, and this includes people like kings or despots just as much as it does democratic politicians. They have a strong incentive to want the boom to go on forever, and so they're going to try and A, provoke it, and B, keep it going. So according to that model, what we had, as I say, is in 2007-2008, is what I described in the Austrian business cycle theory earlier on. You started to come up against structural limits. The Federal Reserve did start to raise interest rates, at which point people realised that lots of investments that had been made were simply not sound. It was exacerbated in this particular occasion by those private sector financial instruments I mentioned earlier, because they had the effect of, as I mentioned in an answer to a question earlier, confusing people about what was actually going on. In other words, there's a lack of transparency about exactly who has got clothes on and who is naked, if you will, who is insolvent and who is simply contemporarily distressed. So the financial engineering and the kind of abstract and artificial kind of instruments that were created in the previous decade also exacerbated the problem. But the underlying problem, as I say, was this combination of huge expansion of credit and hubris, if you like, on the part of people in the financial services sector for various reasons. Now, what does that mean we should be doing now? Well, basically, we should be doing what Andrew Mellon thought we should have done in 1929-30. We should be liquidating the bad debt. In other words, we should be doing what Japan should have done in the early 90s. Japan should have let half its banking sector and about a third of its industrial sector go under. Very unpleasant. And you can see why the Japanese government decided, and the Japanese public decided they didn't want to do this. But they should have done it. What they've done instead is use fiscal and monetary policy to maintain the value of assets in Japan. And the result has been that the Japanese economy has just stagnated. If you look at the graph of Japanese economic growth over the last 30 years, it looks like this.
pretty much. And who knows what will happen at the moment, but that's pretty much what it looks like. That's what the British economy's graph looks like, actually, at the moment, until from 2008 to now. The British economy's graph looks like this. This is 2009. And that's the last quarter at the end now. Everyone is now saying, oh, happy days are here again, the British economy. But in fact, when you look at the figures, I'm afraid, the British economy's recovery is almost entirely credit-driven. It's largely because the government is utterly cynically trying to stoke up yet another house price boom in the southeast of England. My own prediction is that, in fact, we're going to run into quite serious capacity problems in about 18 months' time. But guess what? That's after the next general election. And call me really cynical, I think that's what George Osborne is mainly thinking about. But again, it's very similar, and it's for the same reason. When we went down there, what happened was, if we had done what we should have done, the graph would look like this. But we didn't. We would have had a much more serious contraction in 2009-10, but then the economy would have recovered. Can anybody think of a country that did follow that prescription, that liquidated the bad debt?
Iceland?
Yes, Iceland. Iceland is now the fastest growing economy in the North Atlantic region. They allowed their two of their three biggest banks to go bust. They liquidated a lot of investment. The krona fell dramatically on the foreign exchanges, and as I say, Iceland's economy has now rebounded quite nicely. Also, Iceland is now just expensive to visit instead of unbelievably expensive, which is what it was during the boom. It was the kind of place where you began to think you needed to take out a mortgage to buy a round of drinks in Reykjavik. And it wasn't just because of taxation either, which is the way it is in Norway. So this third group basically say that what we should have done is to basically write off the malinvestment. We should have gotten the bullet. We should have allowed lots and lots of major banks to go bust. We should have allowed Citibank, AIG, Goldman Sachs, these Merrill Lynch, they should have all been allowed to go under. In other words, we should not have stopped Lehman Brothers. We should have let everyone do it. So why did the politicians not do this? Now, unfortunately here I have got some sympathy for the politicians. The problem is this. They feared that if they allowed the major financial institutions to go under, as they should have done, and I think actually quite a lot of them wanted to do, they feared that if they did this, the payment system would collapse. And that what would then happen is that people wouldn't be able to get money out of the cash machine, and after about a week or so, they'd start looting the grocery store to get food. In other words, they feared that the whole of civilization would collapse. Now, suppose I was Chancellor of the Exchequer, and Sir Humphrey comes to me and says, well, Chancellor, you could let the banks go bust, you could let Royal Bank of Scotland go under, and it'll probably work out all right, but I must tell you that there is a 10% chance that you will cause the collapse of civilization and a revolution. Am I really going to take that chance? Do I really want to go down in history as the man who, caused a revolution and brought on the collapse of civilization? Probably not. So the trouble is that while I do think that was the right thing to do, and I do think, on balance, actually, it would have worked out all right, the risk that it could have led to a collapse of the financial system is not trivial. And I can see why, being fair to them, the politicians just weren't prepared to take that risk. The problem, where I do blame them, is that nothing has been done to address the underlying situation. What they should have done is start working immediately on a way to wind up distressed big banks. So the next time this happened, they could simply do it. Plus the other thing is, without systemic risk, plus the other problem is that because of the policies they have followed, particularly because of quantitative easing, there are lots and lots of banks around the world that are still basically insolvent. Royal Bank of Scotland, for example, which the biggest bank in Britain, assets worth more than Britain's entire GDP, in fact 3 times Britain's GDP. Royal Bank of Scotland is still basically insolvent, as it admitted a week ago, when it said that they were thinking of spinning off all their bad debt into a bad bank. This bad bank would have bad debt in it larger than Britain's entire GDP. That tells you straight away that the bank is insolvent, basically. So the view, we still have huge numbers of insolvent financial institutions, but they're being kept afloat by quantitative easing and by the fact that their debts have not yet been written off the books. So that's where I'll stop, because basically that's how to understand it. Oh, sorry, one other thing I do want to say very quickly. As I said, the way people think about the 1930s is the way people think about today. And just as there are three interpretations of what happened in the 1930s, there are broadly three interpretations about what happened in the current crisis. You'll notice, as I said, that pro and anti-market people are on both sides of the argument. So the monetarists, the first lot, are broadly pro-market, most of them. The Keynesians are broadly critical of the market. On the other side, though, obviously the Marxists and the Minskyans are also very anti-market, whereas the Austrians are pro-market. So there are pro and anti-market on both sides of the argument. It's raw a difference of intellectual analysis that goes on. Finally, there's one final thing. I've been talking all the time about the 1930s, but maybe that's the wrong recession. I'll just throw something finally out to you. Maybe we should not be comparing where we are now with the 1930s. Maybe we should be thinking instead about 1873 to 1896, the so-called long depression. What happened was, in 1873, there was a big bubble in Europe and North America in the 1860s and 70s in railways. In 1873, there was a panic on the Vienna Stock Exchange about the expected profits of railway companies. Suddenly people realised that a lot of these railway lines were never going to make money. And this panic then spread to Paris, it then spread to London, and it then went across the United States. There was a huge fall in the stock market in New York. It then came back to Europe the following year, and there was another second massive crash and a huge wave of bank failures. What then happened was this. If you look at the statistics, many countries have very, very low rates of GDP growth after 1873. Britain, France, Austria, they all have very low rates of GDP growth. At the same time, though, in that period, other countries, Germany, Italy, the United States, have quite rapid rates of GDP growth. Also, during that period, you get general deflation. The price level falls by almost 60% between 1873 and 1896. The price of most goods goes down quite significantly. Bread, for example, food generally declines quite dramatically in price between 1873 and 1900. The reason is that you've suddenly got access to the prairies, and so you get all this amazingly cheap grain being produced in North America, which is now being shipped across to Europe in the iron-hulled steamship with an expansion steam engine, both of which were invented in the 1870s. You've also got lots and lots of really good beef from Argentina arriving, much, much cheaper than European beef and really high quality, best beef in the world. At the same time, so what that means is that the decline in GDP actually is illusory, because when you need to apply a GDP inflator because the prices are going down. So in fact, what looks like a slowdown in GDP growth is actually not a slowdown, because you need to apply an inflator, as I say, because prices are falling steadily. Plus, as I said in my first lecture, and going back to Schumpeter, this is the great era of technological innovation. This is when Gottlieb Daimler invents the internal combustion engine, Rudolf Diesel invents the diesel engine. You get the major breakthroughs in a whole range of technologies. You also get major breakthroughs in medical science, chemistry. You get the development of artificial nitrate fertilizer, for example, by German chemists. The invention of aspirin. Robert Koch makes the key breakthrough in diagnostic medicine with the Koch stages of analysis. So what is actually going on here? And I think this is probably what is more likely going on now, but exacerbated by the cock-ups that the politicians and the bankers have made. The technologies that went bust in 1873 were the ones that had been driving economic growth for the previous 100 years. Railways, canals, town building and textiles and steel and iron in particular. The technologies that, or iron I should say actually rather than steel, the technologies that drive growth are starting to drive growth in this period, which are then to drive it for most of the next 100 years, are the new ones. The internal combustion engine, the electric motor, electricity, high quality steel, mass produced steel that is, and the motor car and heavier than air transport, all that kind of thing. So this long recession is actually not really a recession. What it is a long transitional period from one wave of technologies to another. Very painful for the established, older industrial countries like Britain, Belgium, the Netherlands, France, but very nice for the new countries that are starting to grow: Germany, the United States, Northern Italy, Russia, Japan. Similarly, what we're seeing now, I think, is that what the technologies that came in this era have reached are basically no longer really generating large amounts of income. But we've got new technologies coming along: the internet, biotechnology, automation of various kinds. I mean, driverless cars is the next big thing, digital printing, things of that sort, which are going to gradually transform production. I mean, you guys are going to wonder in about 10 years' time why anybody ever owned a car. You'll be amazed at how empty the roads are, because we're going to increase the efficiency of the use of roads by something like 500 to 700% in the next 10 years due to driverless cars. But that is bad news for North America. It's bad news for Europe, because they're the established old industrial areas. It's also bad news for Japan. It's good news for China, India, Brazil, and the other parts of the world. So I think actually we are going to look at history. That's the period that tells us more about what's going on. Like I say, on top of that, though, we buggered up. Right, okay.